A common stock is an equity investment that represents ownership in a corporation form of business. Each share represents a fractional ownership interest in the firm. The key attributes of this investment security is that it enables investors to participate in the profits of the firm. As residual owners of the company, company stockholders are entitled to dividend income and a prorated share of the firm's earnings after all other obligations of the firm have been met. But there are no guarantees they will ever receive any return on their investment. One important investment attribute of common stock is that they enable investors to participate in the profits of the firm, and as such they can offer attractive return opportunities. Other attributes is the versatility of the security. It can be used to meet just about any type of investment objective. In addition, as an investment vehicle goes, common stocks are fairly simple and straightforward, so they're easy to understand, though that certainly doesn't mean they're easy to value. They're also easy to buy and sell, and the transaction costs are modest. Moreover, prices and market information is available in the news and financial media. The stock market has been volatile over the last 15 years. A bull market was followed by a bubble that became a bear market and once again appeared to be quite bullish. Although stocks provide an average annual return of around 11% from 1953 to 2002, there was a significant sell-off in October 1987. While the first half of the 1990s witnessed returns that were slightly below average, annual returns during the second half of the decades were about 26%. A bear market soon followed that resulted in one of the few three-year stretches with negative annual returns. Although stocks have generated rates of returns around 10% per year over the past 50 years, the average annual return over the 2001 through 2005 period was only around 2%. While they don't provide the bang that capital gains do, dividends are an important source of return to stockholders. Dividend returns are always positive, although the dividend yield has been under 2.5% during the past decade. Capital gains have ranged from 38.32% in 1975 to a negative 27.57% in 1974. Over the past 50 years, dividends have accounted for a little less than 50% of the average annual total return from stocks. There's no question that capital gains provide the really big returns, though they also tend to lead to wider swings in year-to-year yields. Dividends, in contrast, provide an element of stability and tend to shore up returns in off years. Currently, the dividends are taxed at 5% or 15% rate, same as the capital gains tax. That could also change here beginning of 2013 if they don't approve the Bush tax cuts. Table 6.1 here shows some historical returns of the S&P 500 index. As you can see here, 1950, total return on dividends was 5.4, capital gains 13.2, or total return of 19.3% return. Not bad. You can see in 1960, 13.3, 4.4% for a total of 7.8. Let's go to the 2000s here. 2000, 1.7 on dividends. Here we had a loss, negative 5.3, for a total return of a negative 3.6%. As you can see here, like I said before, sometimes you can win, sometimes you can lose. Now, if you look from 1950 to 2008, total dividend or average return here was 3.6%, 7% for the capital gains. So if you would have had a portfolio from 1950 to 2008, you'd have generated a return of about 10.8%. Okay, you hear about bear and bull markets here. Let's take a look at a bear market here. Let's look at a routine declining drop of about 5% or more in one of the major market indexes, like the Dow Jones Industrial. This usually occurs several times a year. You can have a correction, a drop of 10% or more in one of the major markets, and then a bear market, a drop of 20% or more in one of the major markets. This happens usually 3 to 4 times a year. Okay, let's look over the advantages of stock ownership again. Provide opportunities for higher returns than other investments. Over the past 50 years, stocks averaged between 10% and high-grade corporate bonds of only 6%. It's a good inflation hedge since returns typically exceed the rate of inflation. Easy to buy and sell. You can do it through a stockbroker, face-to-face, or you can also do it online. Price and market information is easy to find. Yahoo Finance acts. Unit cost per share is low enough to encourage ownership. So there's a lot of cheap stock out there that you could purchase, such as FTR, Verizon, that you could, receive some dividends or dividends and capital gains. Okay, let's continue on with disadvantages of stock ownership. I'm sure you've covered different types of risks, such as the ones we're talking about here. First one, business risk, is related to the kind of business the company is in and deals with both sales volatility and the amount of variance in the firm's earnings. Financial risk is associated with the mix of debt and equity. Of course, the more debt, financial leverage the firm uses, the greater likelihood that it will default on its principal and interest payments, which will in turn have a negative impact on the stock. Then you also have purchasing power risk, refers to the possibility of price increases and corresponding decline in the value of the dollar invested in common stock. Market risk is caused by factors independent of the firms that affects the returns on the firm's common stock. Such things as economic fluctuations, threat of war, and political factors affect market risk and therefore can have a bearing on the market price of a stock. The market itself has an impact on the price performance of stock, which of course is what beta is all about. For example, stock beta is a measure of the extent to which stock reacts to the market, and we'll be talking about beta a little later here. And of course, you have the event risk. We had that a few years ago with Honda there. You had that tsunami, the nuclear reactor there, that had an effect on the stock of Honda. Now, these are hard to predict which stocks will go up in value due to wide swings in profit and general stock market performance, low current income compared to other investment alternatives. Okay, let's look at figure 6.2, the current income of stocks and bonds. As you can see here, bonds tend to have a higher yield than stocks. Then again, you also have the capital gains side of it for stocks here. So if you're looking for a higher return and less risk, you would probably pick bonds. If you're looking for the potential of some income and the possibility of capital gains, you would choose stocks. Okay, let's